Hi guys, I want to take some time and go over the PowerPoint that is attached to this week's lessons. These two slides should look familiar. They were on last week's PowerPoint. The IRS is the Internal Revenue Service. The IRS collects our federal taxes and it oversees the federal tax system. The money that is collected for our taxes goes into the U.S. Treasury, and taxes are the federal government's main source of money. Once you file a tax return, there's a possibility you could be audited. An audit is when you're called in and they look over your tax return and make sure that you did everything correctly. The average person usually doesn't get audited. It's usually if you have like your own business or you have a lot of expenses that you're writing off that might trigger an audit. If you don't file your income tax return on time, you're going to be charged penalties and interest. And these can add up to quite a bit of money. So it's real important that you file your income tax return when it's due on April 15th. Now this year, because of everything that's going on, they've extended it to July 15th. But that's not normal. I mean, normally your taxes are due by midnight, April 15th. A tax return form. You're going to be doing this starting next week. Tax return form will show how much you've earned working and how much tax you owe. The tax return forms have changed in the last couple years. They're much more simple. Before we had like 4 different tax returns forms that you could choose from. Now there's just basically one. And this is what it looks like. So this is where you put all your information. You put all the income you earn. Anyway, we're going to go over this in a couple of weeks. But this is what a tax return looks like. So once again, it shows how much money that you've earned working and how much tax that you owe. Let me do that one. A refund. Now, everybody thinks that they're going to get a refund back, but the only time you get a refund is if your employer withholds more money from your paychecks than you owe. In order to get that money back, though, you have to file a tax return. Not everybody gets a refund. And actually, if you get a refund, it means you basically gave the government a loan interest-free for a year. An ideal situation is you would get 0 money back. It would be perfect. You paid exactly the same amount of federal income tax as that you owed, but that's a very hard number to get. Most people like to get a refund because it's kind of like a little savings account. But you could owe money to the IRS, and I've had that happen many years. So if your employer does not withhold enough money from your paycheck, you're going to owe money to the IRS, and that's due on April 15th. If you don't pay that extra money back on the 15th of April, they will charge you penalties and interest for that. And one of the ways to prevent from owing money to the IRS is making sure that you fill out your let me see if I have it here, W-4 form correctly. And we'll talk about that here in a minute. Tax evasion is failing to report all or some of your income. It's not legal. This is how they get a lot of drug dealers or people doing illegal activities. They get them for tax evasion. Even though, it's illegal, you're not going to pay taxes on it, but that's how they get them a lot of times. Tax avoidance, though, is perfectly legal. Tax avoidance is where you use deductions and credits and adjustments to pay less taxes. Payroll taxes. So these are the payroll taxes that you'll see, and if you're working now and you get a pay stub, you'll see these taxes. Last week we talked about Social Security. It's 6.2% of what you make. Now remember, after you make more than $137,700, you don't have to pay any more Social Security tax. But you will pay 6.2% up to this amount, and once you start making more than that amount, you don't have to pay Social Security tax for the year. Medicare tax, doesn't matter how much money you make, you pay 1.45% on all your income. Now the federal income tax is different. It can range from anywhere from 0 to 37%. Just depends on a lot of different things and what your tax bracket is. And you and I can make the same amount of income and we could be in different federal income tax brackets. But we'll talk about that more later. A W-4 form shows employers how much money to withhold from each of your paychecks. The more deductions you have in your W-4 form, the less taxes you have withheld. And you complete this form when you start a job. I have a picture here of one. W-4 form looks like this, and I don't know if you can see it. You'll have to blow it up on your things. But you fill this out when you start your first job, and this will tell them how much to withhold. So they can withhold nothing. You can fill this out, and they can withhold that exact amount that you figure out when you do this form, or you can have them withhold more. Okay, so it all just depends, but it's really important because if this form is not filled out correctly, you could end up owing a lot more taxes at the end of the year. When should you change your W-4? When you change jobs, you need to fill out a new W-4 form. If you get a second job, it's going to affect the amount of taxes. A lot of times it'll make you actually owe more taxes. So you need to fill out another W-4 form. And when you get married, that also changes the amount of tax that you owe. A W-2 form is something that you get at the end of the year. It shows you how much money you have earned for that year and what taxes were withheld for the year. This form you're supposed to get this form by January 31st of the following year. And if they don't send it to you, if your employer doesn't send it to you by then, they can be penalized. On the W-2 form, it looks like this, okay? This first box here will tell you the wages that you earned. The second box will tell you how much federal income tax was withheld. Okay, now these two boxes can be confusing. These box 1, 3, and 5 are usually the same amounts. It's how much money you made. But remember, once you make more than $137,700, you don't have to pay Social Security taxes. So let's say, for instance, I made $300,000 last year. This box 3 would be $137,700. Box 5 is the amount of your income that's taxed with Medicare tax. So that's always going to be the same as box 1. Okay. Box 2, like I said, is the federal income tax that's been withheld, and that was determined by your W-4 form. Box 4 is your Social Security tax withheld. It's going to be 6.2% of this amount, or this amount. Actually, it's going to be this amount here. Okay, because remember, this amount, if you make more than $137,700, you don't have to pay Social Security taxes anymore. And then Medicare taxes is going to be the 1.45% of your taxable income, all your income. Now, these other boxes here is your employer's name, your employer's ID number. This is where you put your name. These other boxes have to do if you have a retirement plan. When we do our tax return, we're not going to deal with any of these. We're just going to deal with these up here. Okay, but that's what a W-2 looks like. Types of tax forms. 5 years ago, we had like 4 different types of tax forms to use. Now we just have basically one. It's a 1040. This 1040 SR is for people 65 or over. But this is the one that everybody uses now. It's a simple one-page form. Deductions are expenses you're allowed to subtract from your income. In 2020, the standard deductions are, if you're single, you can deduct $12,400 right off the top of your income. So if I make $100,000, I'm only going to be taxed on $100,000 minus $12,400. If I'm married, filing with my spouse, then we can deduct $24,800. And if you're head of household, which means like you're a single parent, you can take the $18,650 as your deduction. So these are amounts you can take right off the top of your income. You don't have to pay taxes on them. Okay. Who must file a tax return? Now this gets a little bit trickier. Most taxpayers are eligible to take the standard deduction, which we just talked about that. It's $12,400 for a single taxpayer. All right, as long as you don't have a type of income that requires you to file a return for other reasons, like if you're self-employed, you have your own business, generally you don't need to file a tax return as long as your income is less than your standard deduction. So if you're making less than $12,200, which that was the standard deduction in 2019, you don't have to pay any federal income taxes. So what I always suggested is if you're a student and you're a dependent, your parents still use you on their tax return, and you make less than this amount of money, I wouldn't have any federal taxes taken out of my paycheck. Because if you have them taken out, you're going to get them all back. But the only way you get them back is if you file a tax return. But you have to be careful, because once you make over this amount, you've got to start paying taxes. Okay? And that's where a dependent. If you're a dependent, these are the situations where you have to file a tax return. And some of you guys work and you make less than this, but you've had federal taxes taken out. You want to get that money back, so you have to file a tax return. Okay. Now, we're going to also talk about tax rates. This is a tax schedule. And you can see it goes from, 0 actually, up to 37%. So this is if you're unmarried, single. This is if you're married. This is if you're head of household. These are the amounts of money that you make. So if you make in between here, you're considered to be in the 10% tax bracket. Okay? Someone that makes more than $500,000 is going to be in the 37% tax bracket. So that's how you read the tax brackets. This is for single people, married filing jointly, heads of household would be, for example, if you are a single parent. All right, we're going to work on this. Well, actually, we're going to work on the actual tax return more starting next week. But you will have to look at tax tables for this week's lessons. And I'm going to talk about your homework in another video.